Back in the mid-'80s, I owned a number of different companies. I sold those companies with the intent of retiring and living off the money from those companies. And that kind of set me on a search to find someone to manage my money. And so I interviewed stockbrokers, insurance companies, everyone who called themselves financial advisors to have them manage my portfolios for me. And essentially I was always told the same thing, which was give us your money, we'll diversify it across different asset classes. And then over time the markets usually go up, and over time hopefully your account will go up and you'll pay us a fee to do that, and hopefully it'll all work out. And I just didn't feel comfortable giving my life savings to someone and hoping it would all work out. And I knew that because I'd done a fair amount of trading before I sold my companies, and I knew that different sectors moved at certain times. Different sectors would be positive for 6 to 24 months at a time. Other sectors would be negative for that same period of time. And it didn't make a lot of sense to me to be investing in sectors that were going nowhere for endless amounts of time. And I felt that if you could figure out which sectors are moving, that's where you want to be invested. And that was kind of part of my quest. The other thing that I knew was that with the market usually goes up about 2 out of every 3 years. So about 2/3 of the time the market's going up, which means about 1/3 of the time the market's going down. There's a certain time when there's a ton of risk in the market, and I didn't want to have exposure when there's a ton of risk in the market. And so that kind of set me on a quest to do 2 things. One, figure out where to invest at the proper times and how much to be invested on an ongoing basis. And that's really the essence of what we do at Paragon, is we're trying to answer those 2 questions. And we've got 23 years of research doing that.
Most advisors, their core area of expertise is not with money management. It's more, they know the products and different things out there, but not the different ins and outs of the market. So I think you want a professional to manage your money, not a salesperson.
The main difference is that we're actively managing the portfolio as opposed to most advisors who are passively managing the portfolio. And what that means is on an ongoing basis, we're actively taking market data, we're recognizing the different parts of the cycle that the market is in, and we're adjusting to those stages. In terms of performance, because there's always been a big debate on which is better, active or passive. And in my opinion, our numbers speak for themselves. So far this year, our growth account is up 17.2% versus 10.9% for the S&P 500. Since the inception of our portfolio back in 1998 through July, it's up 301%. Versus 24% for the S&P 500. So basically, using active strategies, we've crushed the numbers generated by passive strategies. But like I say, it's an ongoing debate. People debate it back and forth, and I just say, look at our numbers. They speak for themselves.
So with active management, what we're doing is, not only do we do the initial allocation, take a look at someone's risk level, their risk tolerance, put them in what is a good customized portfolio for them. But then after that, we're constantly monitoring the portfolio, watching things as they're moving up and say, well, is it a time to get out now? Should we get out? And then is there something else? Because basically we'll monitor every single different asset class out there on a relative basis and then rank them to say which ones are the best at the top of the rankings. So something might be good to hold, but there may be something better. A lot of advisors just put you in a little bit of everything. We say, rather than a little bit of everything, let's get into the areas that are performing the best or give us the best reward to risk ratio. That way it gives you a more efficient portfolio. You're in the things that are doing well, avoiding things that are not doing well. And I think that's the active approach that we take. I think most people think their advisors are doing that, and they're unaware that they're not even doing that at all. And so I think most people overpay for what their advisors to do. And with this approach, I think it just keeps you with the markets, helps you to get out of the markets too. And so it's just, like I said, I think it's a better dynamic approach. And that's what a person thinks they're paying their advisor to do, and that's what we actually do.
Yes, we definitely take into account the level of risk that they want to invest at. That's probably the single most important decision that a client makes if they're going to meet their long-term objectives. If they don't, if they're investing at a higher risk level than they're comfortable with, odds are they'll never stay with the program and they won't get the long-term returns. So having a person invested according to the risk tolerance is really, really important. The way that we do that is we have our potential clients go through a risk tolerance quiz and then an interview to try and determine how much risk they're comfortable with. And then we rank that from 1 to 10. And 1 would be super conservative, 10 would be more on the aggressive side. And most of our clients are somewhere in that spectrum. They're either a 4 or an 8 or a 6. Wherever they fall on the risk scale, that's how we manage the money, is to that risk level. And the way that we do that is the top flight portion of the portfolio is the growth side that we've talked about. We've also got the managed income portfolio, and the managed income portfolio is dealing with the conservative side. That portfolio was designed after the 2001 terrorist attacks. We had a lot of clients requesting something that was more conservative, and people were scared of the stock market. They weren't getting any kind of returns out of their CDs, and they wanted something to solve that. And that's what managed income is all about. So as far as the risk level that we put them at is once they take the risk tolerance test, once we have our interview and we come up with a number, then we manage them to that number by combining our conservative portfolio and our growth portfolio. And that gives them 2 actively managed portfolios that are designed to manage to a specific risk level. So even though we've got several hundred clients who all have different needs, different objectives, each of them is managed to their particular risk level.
I believe in what we're doing here. And so 100% of my 401k is invested in Top Flight, so right along with our clients. I'm not telling them to do one thing and then doing something else. So our money, is invested just the same as our clients. And so in that regard, our interests are aligned with their interests. We're not telling them one thing and then doing something else. And, I think it creates a win-win scenario. The clients know that, hey, they're managing their own money the same way they would manage my money. They're not doing something different that way. And I think in the industry, you'll often see people not doing it. You'll see a lot of people doing something different than what they're telling their clients. And if advisor's not willing to take his own advice, what good is that advice?
If you're interested in learning more about Paragon, just click on the link and request a complimentary portfolio review. In that review, we'll look at your situation, we'll look at the way you're invested right now, and we'll make recommendations on how you can improve it.